Hello, sir. I'm Basha. I have chosen the topic macroeconomics in fiscal policy. What is fiscal policy? It is defined as the policy under which the government uses the instruments like taxation, public spending, and public borrowing to achieve various objectives of economic policy. Here are some of the images for the fiscal policy. Fiscal policy. These are the types of fiscal policy. It can be classified into three types. That first one is fiscal neutral policy, and next one is expansionary fiscal policy and contractionary fiscal. Here are some of the explanations of this types of fiscal policy. Neutral fiscal policy. It have been the government spending entirely funded by the tax revenue and there is no need of borrowing. Expansionary fiscal policy. It have been the government spending exceeds of tax revenue. This happened due to the times of recessions. Contractionary fiscal policy. It have been the government spending lower than that of the tax revenue. It can be paid by down of the government debit. Here, in neutral policy, government spending and taxation will be equal 50 and 50. And expansionary fiscal policy, in government spending higher than up to 70%. In contractionary fiscal policy, taxation will be higher than up to 70%. Here are some of the objectives of the fiscal policy. That are the major objectives like uh, increase the employment opportunity and accelerations of economic growth and mobilization of resources and minimize the inequalities of income and wealth and price stability. Here, these are some explanation for objectives of fiscal policy. Price stability. It defined as the regulation of price for all goods or things. It regulates the nation through the economic growth is steady during the inflationary time. It regulates the prices throughout the nation by regulating the supply of essential goods and service. The government support price stability. As a result, it invests in money, in rationing and stores the reasonable prices and sufficient supply of food grains. Additionally, it provides subsidies for utilities like transportation, water, cooking gas, and keeping the price low for regular people to afford it. Next one is complete employment. Employment is the top priority in every nation need to better economic situation. India has the highest number of young people, increases likelihood of development. The younger generation more capable than older generation in several areas. Our nation could offer full or almost full employment, evaluate the economic statistic to the next level. The fiscal policy guide choices pertaining to employment. Government have more job opportunity in number of different ways. One, it produce job will build a public sector busy and provide with the private sector and other benefits such as tax break, lower tax rate and so on. Additionally, it promote people to launch small cottage and rural business in order to the employment, giving some tax benefit, incentive, subsidies and a low interest loan. Few ways to do this. Economic growth. It is the nation's growth rate and it aid meeting needs. The heavy industries like steel, chemical, fertilizers and industrial machineries is the one of the way government promotes the economic growth. It builds some infrastructure that support the economic development including like road, bridges, railways, schools, hospitals and electricity supplies, telecommunication and so on. Now we have seen the tools of fiscal policy. It can be classified into public revenue and public expenditure. Public revenue, it can be classified revenue receipt and capital receipt. Public expenditure, it can be further classified into revenue expenditure and capital expenditure. Revenue receipt, it can be classified tax and non-tax. Tax further subdivided into direct tax and indirect tax. Here, this is the definition of capital receipt. A receipt that either create liabilities or reduce the assets of government is known as Capital receipts. Here some of the example for capital receipts like sale of land, investments and borrowings. Here this is the image for capital receipt examples. Revenue receipts. It can be a business through normal business operations is called revenue receipts. Here it can be the examples of revenue receipts like loyalty and received loans for advanced. Here this is some difference between the capital receipts and the revenue receipt. It can be amount received by the sales of fixed assets or received from loan taken. Here revenue receipt, it means that amount reduced by the sale of good or retiring of services. It is a balance sheet. It is showing trading or profit and loss account. It can be the capital receipts are usually non-recurring nature. It having the recurring nature. It is not received in course of normal business activities. It can be the course of normal trading operation. It is not available for payment of profit to the owner of the business. It is available for payment of profit of owner business after deduction of all revenue expenses. Here, definition for the capital expenditure. It means the money that have been spent to acquire, repair, update, or improve a fixed company assets such as building, business, or equipment. Here, this is example pictures of the capital expenditure. Revenue expenditure. That means expenditure which are incurred during the normal business operation. Benefit will be received same period, and examples of rent expenses, utility expenses and salary expenses, insurance expenses, commission expenses and manufacturing. Definition for direct tax. It can be individuals and company by the country's supreme tax body. Direct tax are directly paid by those on whom it can be imposed. Indirect tax, it can be tax levied on consumption of goods and service. It is not directly levied to the income of a person. Here, these are some examples of direct tax and the indirect tax. Direct tax, for example, an income tax a consumer directly pays to the government. It indirect tax, example, income tax, it consumer pays to manufacturers, manufacturers pay to the government. And here's some effects of taxation on production. It can be the ability of to work, save, and invest. Taxes reduce the disposable income and bitterly poor section purchasing power and to acquire the necessities, comforts, and luxuries. Willingness to work, save, and invest. Effects of taxation. People's are willingness to work due to monetary burden of tax and purity due to the physiological states of the taxpayers. Invest is also affected by the psychological of taxpayer. This taxations of allocation of resources, it can be the size of production as well as the pattern of production in the economy. It may ultimately analyzes produce some beneficial effects on production. Thank you, sir.